Welcome to the deep dive.
Yeah.
Okay, today we're taking a bit of a necessary detour. We're stepping away from the flashy world of brilliant software and those viral chatbots. Our destination is, well, the hard, cold physics, the stuff that actually underpins this massive $7 trillion promise of artificial intelligence.
Right. It's about the foundations.
Exactly. And our mission today is to map out precisely where the value is actually going to accrue over the next, say, 3 crucial years or so, 2025 to 2028.
Yeah.
And why that map, when you really look at it, looks less like a typical software ecosystem and maybe more like a battle over physical resources.
It's probably the key insight right now. Separating the signal from the noise. For the last couple of years, everyone's been focused on the speed of innovation, the software side. But the reality, the hard reality, is that the exponential growth we're seeing, it's fundamentally driven by one single unyielding constraint.
Which is?
An absolutely insatiable demand for computational power, for compute.
And that's the paradox, isn't it? The thing we really have to grasp. AI promises this almost like boundless, ethereal innovation. Trillions in potential annual value.
Yeah, the potential is staggering.
But that promise is just slamming head-on into profoundly finite physical limits. We're talking about the molecular precision needed for semiconductors.
Right.
The actual physical space constraints of data center capacity. And maybe most critically, the sheer capacity of the global energy grid.
It's a collision course, and this collision, it's creating a really deep economic split, a bifurcation across the whole industry.
Okay.
We're seeing the emergence of what we're calling the compute oligarchy.
The compute oligarchy.
Okay. Yeah. These are the companies that control the fundamental means of production, your semiconductor designers, the manufacturers, the giant hyperscale cloud providers.
So the ones who own the hardware, the land, the power lines, basically.
Exactly. They own the infrastructure. And then on the other side of that divide, you have the intelligence tenants.
Tenants, okay. Renters.
Pretty much. These are your foundation model developers, the application companies, the vast, vast majority of startups. They are completely structurally dependent on renting compute access from that oligarchy.
So if you don't control the supply chain yourself,
you're forced to pay. You pay a massive and, frankly, escalating compute tax.
Got it. So this deep dive today, it's essentially a roadmap. We're unpacking the source material to reveal why your strategic position relative to these physical compute constraints, not just how clever your software algorithm is becoming the ultimate factor determining company valuations in this new AI economy.
That's the core argument we need to explore.
Right. So let's unpack this. Maybe start with the sheer magnitude. The scale of this economic opportunity, this AI supercycle we're in.
Yeah.
It's actually kind of hard to wrap your head around.
It really is unprecedented. I mean, if you just look back to 2023, the global AI market was valued at, what, around $185 billion?
Okay, respectable.
But the growth rate is the staggering part. Look forward to 2028. The projection is that the market crosses the monumental $1 trillion threshold within that single year.
$1 trillion. Just to anchor that for everyone listening, that implies a compound annual growth rate, the CAGR, right?
Yeah, the smoothed average growth.
Somewhere between 40% and 55%. So, favorable conditions hold.
Which is just, in any mature industry, a 55% CAGR would be completely unthinkable.
Absolutely wild.
And we know the main catalyst here is generative AI, Gen AI. That segment alone, it's projected to surge from about $71 billion in 2025 to nearly $900 billion by 2032. So this isn't some fleeting trend. It's a fundamental technological shift. And that's what's justifying or attempting to justify those valuations.
And crucially, this valuation isn't based on abstract tech hype like we saw in the 90s .com bubble.
No, not entirely.
It seems to be based on hard, measurable productivity gains. I saw McKinsey's research estimates Gen AI has the potential to add, an incredible $2.6 trillion to $4.4 trillion in annual value.
Annually. To the global economy.
That's transformative value. This feels like a legitimate productivity-enhancing revolution, not just hype.
And that kind of real-world impact, it's being internalized by corporations right now. You see firms expecting efficiency gains climbing up to maybe 25% across their organizations.
Within the next few years?
Within the next 3 to 5 years, yeah. Particularly in those areas where language processing, data analysis, where those are the bottlenecks.
And we already have some pretty astonishing examples showing the raw power of this, don't we?
We do.
Take Walmart. A company defined by its sheer logistical scale. They apparently saved an estimated $75 million in 1 year.
Just from AI-driven supply chain optimization.
That's operational efficiency hitting the bottom line directly. Pretty compelling.
And maybe even more indicative of the labor shift.
Hmm.
Look at JP Morgan Chase.
Hmm.
They deployed an advanced AI system. It automates these complex loan reviews. And get this, it performs the equivalent of 360,000 staff hours of work annually.
360,000 hours. That's what, like almost 18 months of work for a team of 200 people?
Right, basically, yeah.
Yep.
Automated in real time.
Yeah.
That level of ROI, that's the fuel driving this entire investment engine.
But as we set up at the start, that immense economic value is directly, inescapably dependent on physical compute.
Right.
And when we talk about compute, we really need to differentiate between two crucial phases, don't we? Because they dictate totally different economic strategies, training versus inference.
Absolutely critical distinction. Training is that initial colossal investment, the CapEx phase.
Right, so big upfront costs.
This is when you're building one of these massive foundation models like the latest GPT or Gemini versions. Right. A single training run. It can cost tens of millions of dollars.
Wow. Just
in compute alone, often using thousands upon thousands of cutting-edge GPUs running continuously for weeks, maybe even months.
So that's where the hardware suppliers, the NVIDIAs of the world, make their big money up front.
That's a huge part of their revenue, yes. But the long-term, the dominant cost driver, that's inference.
The operational phase.
Exactly. Every single query somebody makes, every line of code generated, every single interaction with the AI model, that's inference.
And the difference in resource consumption between training and inference is just staggering, isn't it?
It really is. I think I saw various analyses suggesting a single query to a large language model service like ChatGPT requires nearly 10 times the electricity of a standard Google search.
10 times for one query. That fundamentally changes the economics over time.
It profoundly shifts the architectural challenge.
Yeah.
While training grabs the headlines, the projections show inference becoming the structurally dominant AI workload by 2030.
Okay, so the ongoing running cost will dwarf the initial training cost eventually.
Massively. Which means hardware development has to pivot. It can't just be about sheer brute force training power anymore. It has to move towards extreme operational efficiency. Specialized inference hardware.
Why? To mitigate that escalating operational expense, that sort of perpetual compute tax you mentioned.
Exactly. Otherwise, the running costs become unsustainable for the tenants.
Which leads us to this final, structural reality of this whole supercycle. Compute demand. It's growing at more than twice the rate of Moore's Law.
Right. Over the past decade.
Moore's Law. The idea that transistor density doubles roughly every 2 years. That's been our steady guide for 50 years.
Our predictable friend, yeah.
But AI demand is just blowing past it dramatically.
And that gap, that widening gap, creates what economists call a structurally inelastic demand loop.
Meaning
the technology providers are literally struggling to keep up with the appetite of the model developers and the users, which means investing in compute capacity isn't an optional expense for companies anymore.
It's strategic. Existential, even.
It's an existential imperative, and that guarantees premium profits for anyone who successfully controls the supply of that compute.
Okay, let's just pause and absorb that scale for a second.
Yeah.
Demand is structurally inelastic, outstripping Moore's Law. So now we have to confront the $7 trillion reality check.
Mm-hmm.
If the demand side is effectively infinite, what are the physical bottlenecks on the supply side? The things that actually constrain supply and dictate where all this value flows.
Right. Well, the first step is watching that abstract demand translate into something very concrete. A massive physical construction boom. We're talking about specialized AI factories.
Data centers, basically, but supercharged.
Exactly. And meeting this demand, analysis suggests, requires nearly $7 trillion in total capital expenditure by 2030.
$7 trillion?
Yeah. That breaks down to roughly $5.2 trillion targeted specifically for AI-related compute infrastructure. Yeah. Plus another, say, $1.5 trillion for all the associated traditional IT infrastructure upgrades needed to support it.
That is just a phenomenal number. $7 trillion. We're talking about building industrial capacity on a scale maybe only comparable to massive Cold War military buildouts, but for data processing.
It's that kind of scale transformation, yes. And the facilities themselves, they're terrifyingly large. Cloud providers aren't just building data centers, they're building megacenters.
How mega?
We're seeing plans from 500 megawatts all the way up to 1 gigawatt of power consumption for a single site.
1 gigawatt?
Yeah.
That's That's the power consumption of a small city, isn't it?
It's basically a small metropolitan grid. It could power hundreds of thousands of homes. We're literally converting vast tracts of land into these specialized, high-density computing factories that need immense infrastructure upgrades just to plug them into the grid.
And the costs for these individual facilities must be soaring, which just compounds that inelastic supply problem.
Oh, absolutely. Price tags for a single large AI data center are expected to climb to at least $10 billion soon.
$10 billion for one center.
And critically, the construction timelines are getting longer. It used to take maybe 2-3 years to build a large data center.
Right.
Now we're seeing projections stretching out to 6, maybe even 8 years.
Why the delay?
It's a combination of factors: supply chain constraints for specialized equipment, complex permitting delays, and increasingly, the sheer difficulty of securing sufficient power access from the grid. The utilities can't keep up.
Which brings us neatly to the truly global, maybe the ultimate long-term choke point. The global energy crisis being fueled by AI's thirst for power.
It's a massive issue. Global data center electricity consumption is projected to more than double.
Double from today's levels.
Yes, exceeding 1,000 terawatt hours, or TWH, annually sometime between 2026 and 2030.
1,000 TWH. I mean, that's more than the current annual electricity consumption of entire highly industrialized nations, right? Like Japan or Russia.
That's correct. The scale is just monumental. AI is consuming the world's power generation capacity at an unprecedented, almost alarming pace.
And you can see the direct impact on local grids already, can't you?
Definitely. In the U.S. alone, AI data centers are projected to add 100 gigawatts of new demand to the grid by 2030.
100 gigawatts, just for AI centers.
Just for AI centers. That kind of demand spike necessitates massive urgent upgrades to transmission lines, and it means building new power plants, often natural gas peaker plants, to meet that load.
And here's where the cost becomes acutely real for you, the listener, right?
Yeah.
What often gets glossed over is that residential and commercial electricity bills, they're demonstrably rising in areas with heavy data center concentration. Why?
Well, because the immense necessary grid expansion and the new power generation required for this AI gold rush, it has to be paid for. And it's being subsidized, at least in part, by the general ratepayers.
So the cost of the AI revolution is effectively being socialized onto everyone's utility bills.
To a significant extent, yes. Which brings us to the potentially unsustainable economics of it all. This huge CapEx burden creates what some are calling a compute bubble risk.
Because the spending is so far ahead of current revenues.
Exactly. The spending is hugely speculative right now. To justify the hundreds of billions in annual CapEx being poured into the ground, into these data centers, the private sector needs to generate an estimated $2 trillion in new annual revenue from AI services.
$2 trillion a year needed to justify the build-out. And here's the explosive fact I saw in the source material. Analysis shows that even under pretty aggressive AI adoption scenarios, the industry is projected to fall roughly $800 billion short of that required $2 trillion goal annually.
800 billion short. That suggests the current rate of spending is fundamentally speculative. It relies on a future revenue stream that might simply not materialize at the speed or scale everyone is banking on.
The profitability paradox is genuinely alarming when you frame it like that.
It is. Investment managers estimate the industry needs to generate somewhere between $320 billion and $480 billion in revenue just to break even on the data center CapEx plan for 2025 alone.
Just to break even on 1 year's build-out. And you compare that to current actual annual AI-specific revenues, which are closer to what, $20 billion? Maybe a bit more now?
Something in that ballpark, yeah. The gap between the investment pouring in and the current cash flow being generated is just vast, a chasm.
And that cost pressure, it's already acting as a brake on adoption, isn't it? It's directly affecting those intelligence tenants.
It is. That IBM survey finding was remarkable.
Which one?
The one where 100% of executives surveyed, not a majority, 100%, reported having to cancel or at least postpone at least one Gen AI initiative.
Specifically because of compute costs.
Specifically due to concerns over high compute costs, which, by the way, are expected to climb another 89% between 2023 and 2025.
Wow. Okay, so that's not just a theoretical risk anymore. It's a measurable adoption barrier today.
It absolutely is. The financial risk is becoming very real very fast.
So if the cost is that prohibitive for the users and the supply of compute is this constrained by physics and energy, we know exactly where the value is concentrating, don't we?
It has to.
It's flowing straight to those who control the scarce resources. Which takes us logically to the structure of this bifurcated value chain we talked about, starting with the compute oligarchy.
Let's start at the very bottom of the stack, the semiconductor stratum. These are the true picks and shovels of the AI gold rush.
And right now, that stratum is dominated by one name, NVIDIA.
Utterly dominated. They command a staggering 80% to 94% market share in the crucial data center GPU segment. Their valuation, which is flirted with $5 trillion,
incredible,
reflects them being valued not just as a hardware maker, but as an indispensable platform company.
And the real power behind that platform valuation isn't just the silicon itself, is it? It's the software. It's CUDA.
Absolutely. CUDA is the proprietary software moat they spent over a decade, maybe closer to 2 decades, meticulously building. It's this vast ecosystem of tools, libraries, optimized code. Entire generations of engineers are trained on it.
So if you're a company using NVIDIA and you want to switch to a competitor,
it's incredibly difficult and expensive. You're not just swapping out a chip. You're potentially spending millions, maybe tens of millions in staff hours, rewriting, reoptimizing, retraining your entire software stack. The switching costs are enormous.
Extremely high. Okay. But that dominance, it is facing a credible challenge now, right? From AMD.
It is. AMD's Instinct series of GPUs is the most credible challenger, and they're being very clever strategically. They're aggressively promoting their open-source ROCm software platform.
Open source as the differentiator.
Or exactly, positioning it as the anti-NVIDIA, the open alternative. And this strategy is explicitly designed to appeal to the hyperscalers. Your Googles, Amazons, Microsofts.
Who are desperate for a second source.
They are desperate to diversify their supply chain and gain some leverage against NVIDIA's immense pricing power. They need AMD to succeed to some extent.
And we can't talk about silicon, about the foundation of this whole oligarchy, without acknowledging the ultimate geopolitical choke point. Taiwan, where TSMC produces the most advanced chips for basically everyone. NVIDIA, AMD, Apple.
Holding over 61% of the global foundry market share for advanced nodes, a major disruption in that region. It would effectively halt the production of cutting-edge AI silicon globally. Full stop.
A single point of failure for the entire AI revolution almost. Okay, moving up the stack from silicon, we hit the hyperscaler nexus, the landlords.
AWS, Azure, and Google Cloud Platform, GCP. They are, ironically, the largest customers for NVIDIA and AMD.
Buying up huge amounts of chips.
But they are also the largest landlords, renting that compute power back out to everyone else, including the AI startups.
And their spending is just colossal. Their collective annual CapEx is projected to approach, what, something like $400 billion in 2026?
That's the projection. And that spending represents a direct, continuous transfer of value from the entire global technology world straight into the pockets of the infrastructure layer, the oligarchy.
So what's their primary defense against just becoming a pass-through for NVIDIA's profits?
Their main strategy is building their own custom silicon moats.
Designing their own chips.
Exactly. They are sinking billions and billions into self-designing chips, specifically optimized for AI workloads, both to improve performance and, crucially, to optimize their total cost of ownership, their TCO.
And reduce that dependency on external suppliers like NVIDIA.
Precisely. AWS really pioneered this years ago with chips like Trainium for model training and Inferentia for inference.
Right.
They've cited cost savings of up to 40% compared to using external GPUs on specific training workloads. That's a crucial internal strategy for them to protect their own gross margins.
And Google took this even further, didn't they?
Yeah.
With their TPUs.
Yeah, Google went all in very early with their TPU's tensor processing units. They're now on their 6th generation, called Trillium. TPUs are a key differentiator for them, especially for massive scale training.
Wasn't that part of their big deal with Anthropic?
It was core to their multi-billion-dollar partnership with Anthropic, yes. Google realized very early on, if you don't control the means of computation, you ultimately can't control your costs or your own innovation timeline.
And Microsoft. They're heavily tied to NVIDIA through OpenAI. But are they doing custom silicon too?
They are. Despite the deep OpenAI partnership, Microsoft is also developing its own Maya AI accelerator chip and a CPU called Cobalt, this widespread push towards vertical integration. It's not just about innovation for its own sake.
It's offensive.
It's a necessary defensive strategy to ensure their future profits aren't entirely consumed by the chip suppliers sitting below them in the value chain.
Okay, so that's the oligarchy. Semiconductors and hyperscalers. Now, let's analyze the other side, the intelligence layer, the tenants' reckoning, as you called it.
Right. Here you have the foundation model developers themselves, like OpenAI, potentially valued around $500 billion.
Astronomical numbers.
And Anthropic, maybe $183 billion. They've achieved these incredible valuations. But you have to understand, these valuations are based less on current profitability.
Which is probably minimal or negative.
Likely. And more on strategic potential, and crucially, their deep integration with their hyperscaler partners. OpenAI with Microsoft, Anthropic with Amazon and Google.
They're tied at the hip. But these tenants, they face two really severe interconnected headwinds, don't they?
They do. First, as we discussed, is that relentless compute tax.
The cost of running the models.
The high and, importantly, variable cost of running these models at scale, especially the inference part, day-to-day usage. It massively compresses their gross margins. They are fundamentally renting the essential infrastructure, and those rental costs are rising, likely faster than their potential revenue in many cases.
And the second headwind
is what we call platform risk.
Meaning the platform can just replicate your features.
Exactly. Features built by application startups, often just thin wrappers around an API. They are incredibly vulnerable to being easily and instantaneously commoditized as the underlying foundation models improve.
So the moment GPT-5 or whatever comes next launches a new native capability,
it can instantly absorb and render obsolete an entire category of startup applications that relied on wrapping the previous version's API. It's brutal.
So the takeaway then for investors looking at this space or founders building companies, it's pretty stark, isn't it?
It is. Sustainable value, long-term value, will only accrue to those companies that build durable moats that exist beyond the core AI model itself.
Meaning what specifically?
Meaning things like acquiring and defending genuinely proprietary data sets, achieving deep integration into customer workflows, which creates high switching costs, and demonstrating a clear, credible path to profitable unit economics.
Right. You have to make more money per user than you spend on compute for that user.
Fundamentally, yes. And investors are becoming hypersensitive to this margin structure. When you look at the valuations for AI-native SaaS companies today, the median enterprise value to revenue multiples are still high, maybe 20x to 30x annual recurring revenue.
ARR.
Which is way above traditional software.
Way above. For comparison, a healthy traditional SaaS company might trade at, say, 2.5x to maybe 7x ARR. That massive premium for AI companies. It's being reserved only for those who can convincingly demonstrate they've mastered that compute tax and built those durable non-model moats.
And if they can't,
they'll quickly see their valuations fall back towards those much lower traditional SaaS multiples. The market is starting to differentiate sharply. Okay, this is where, for me, it gets really interesting. If semiconductors are the absolute foundational layer of this entire $7 trillion economy, then we absolutely have to talk about the one company that makes all those advanced semiconductors possible, the single ultimate technological choke point in the entire system. ASML?
ASML, the linchpin. You're right, they're not a chip maker themselves. People often get that confused.
Right, they don't make chips.
No, they make the machines that make the most advanced chips. This Dutch company holds the world's sole monopoly 100% market share on extreme ultraviolet or EUV lithography machines.
And these EUV machines...
Yeah.
They're essential for what?
They are absolutely essential for producing all advanced chips at the 7-nanometer node and below. So the chips powering the latest iPhones, the most powerful AI GPUs from NVIDIA and AMD, none of them exist without ASML's EUV machines.
No ASML, no cutting-edge AI silicon. It's that fundamental.
It is that fundamental. And that monopoly, it wasn't just stumbled upon. It's the result of what one analyst aptly called a $9 billion 30-year odyssey.
30 years?
Roughly. This wasn't some incremental improvement project. It was a decades-long, high-risk technological wager on solving a physics problem so fiendishly complex.
That who? Nikon and Canon.
Exactly. Former lithography giants like Nikon and Canon eventually abandoned their own EUV research programs entirely. They concluded the challenge was just too immense, too complex, and way too costly to solve. They gave up.
You really have to try and grasp the technological moat here, the sheer complexity. Each machine costs Up to $380 million?
In that range, yes. And it's arguably the most complex commercial machine ever conceived by humans.
And the core process, creating that EUV light.
Yeah.
It sounds like science fiction.
It basically is. To create the specific 13.5 nanometer wavelength light needed, they fire a high-powered CO2 laser at microscopic droplets of molten tin. Molten tin. Falling perfectly through a vacuum chamber. This creates a tiny plasma explosion, reaching 220,000 degrees Celsius.
Hotter than the surface of the sun.
Considerably hotter. And they have to do this, hitting these tiny falling droplets with the laser with perfect synchronization, 50,000 times per second.
Wait, let's just stop and process that. Managing a 220,000 degree plasma event precisely 50,000 times every single second inside a machine.
Continuously, for weeks or months on end in a fab.
That's not just clever engineering. That's physics mastery at a scale humanity has arguably never achieved before in a commercial product. It really validates that 30-year Odyssey description.
It absolutely does. And the optical feat inside the machine is equally miraculous because that 13.5 millimeter light is absorbed by almost everything, including air and conventional glass lenses.
Right.
The entire light path must be maintained in a near-perfect vacuum. And instead of lenses, it uses incredibly complex reflective optics, mirrors.
Made by Carl Zeiss.
Made by their partner, Carl Zeiss. And these mirrors are, quite literally, the flattest surfaces ever created by humans.
How flat?
The analogy they use is, if you scaled one of these mirrors to the size of, say, Germany, the largest bump or imperfection on its entire surface would be less than a millimeter high.
That level of precision, it basically ensures that the monopoly is impossible to replicate quickly. You can't just reverse engineer that.
Not in years, maybe not even decades. But ASML didn't just rely on technical brilliance. They also secured their monopoly through some pretty shrewd strategic genius. Remember the Musketeer project back in 2012?
Vaguely. Refresh my memory.
Intel, TSMC, and Samsung, the three largest potential customers for EUV, and the only ones who could realistically fund a competitor, they were convinced by ASML to co-invest $1.38 billion into ASML itself.
So they became part owners.
They became part owners and, crucially, guaranteed ASML a market for the hugely expensive EUV machines they were developing.
Which was a masterstroke.
Because it completely eliminated their incentive to fund any potential competitor to ASML. Why fund a rival when you part own the winner and have guaranteed access? It effectively starved any potential rival effort of the essential industry support and the colossal capital needed to even attempt to challenge ASML's EUV dominance. They locked in the entire ecosystem.
Wow. Okay, and that lock-in, combined with the technical monopoly, gives them immense pricing power, right? And incredible revenue visibility.
Unrivaled visibility. They have this colossal order backlog for their machines, reportedly around 33 billion as of late 2025.
33 billion euros in confirmed future orders.
Yeah. This makes the demand for their flagship products structurally inelastic. It's highly resilient to short-term economic downturns. No serious chipmaker planning future nodes can afford to cancel their place in that multi-year queue. It would mean falling fatally behind their competitors.
And ASML isn't just sitting still, are they? They're already rolling out the next generation, extending this moat even further. High-NA EUV.
Exactly. High-NA, or high numerical aperture EUV. This is the next growth engine. It increases the numerical aperture of the projection optics, basically. Its light collection and focusing ability from the current 0.33 to 0.55.
Which means, in plain English for us non-physicists.
In plain English, it enables printing even finer features on the silicon wafer. It pushes the resolution down from about 13 nanometers to just 8 nanometers.
Wow.
That's roughly a 1.7x improvement in resolution, which, due to the way chip layouts work, allows for a staggering 2.9x increase in transistor density on a chip.
So this is basically how Moore's Law keeps surviving, even when it feels like we're hitting fundamental physical limits. ASML finds a way.
ASML provides the tools that allow Moore's Law, or its economic equivalent, to continue. And this technological leap, High-NA, is the primary driver for ASML's future revenue and, importantly, margin expansion.
Because these new machines are even more expensive.
Considerably more. The new High-NA systems are priced somewhere between $370 million and $400 million per unit, more than double the price of the previous generation EUV machines.
Doubling the price tag.
Which is why ASML is targeting an industry-leading gross margin of 56% to 60% by 2030, They're leveraging their monopoly position with an even more premium, indispensable product mix.
And we're already seeing the next phase of the foundry wars playing out through the adoption of High-NA, aren't we?
We are. Intel's being very aggressive here. They're the early adopter, reportedly securing all of ASML's 2024 High-NA production capacity.
Why? To get a jumpstart.
For their crucial 14A node, it's a clear strategic bid to leapfrog their rivals, TSMC and Samsung, in process technology leadership after falling behind for years.
And TSMC's approach?
TSMC seems to be adopting a more cautious, measured approach to High-NA, perhaps waiting for the technology and its economics to mature slightly.
But here's the beautiful part of ASML's position, isn't it?
It is. They are the sole indispensable arms dealer in this incredibly high-stakes war between the chip foundries.
They win regardless of who pulls ahead. Intel buys machines, TSMC buys machines, ASML profits either way.
Exactly. They sit right at the epicenter of this massive economic conflict, profiting handsomely from the strategic desperation of their customers to stay at the cutting edge.
And leading this unique technological and geopolitical entity, the CEO matters. Christophe Fouquet. His background seems highly relevant.
Extremely. He holds a master's degree in physics from Grenoble, not an MBA, a physicist, and he spent years within ASML spearheading the complex, arduous task of actually industrializing the EUV program, getting it from the lab into reliable factory production.
So he understands the deep tech intimately.
That kind of deep technical understanding is absolutely non-negotiable when your flagship product involves controlling 220,000-degree plasma and manipulating light that can't even pass through air. His leadership doctrine seems to blend that technical depth with what they call radical customer centricity.
Like that quote, "We are only as good as our customers allow us to be."
Exactly, and also a necessary ecosystem humility. They openly acknowledge their reliance on specialized partners like ZISS for the optics or the suppliers of the hyper-pure molten tin. They know they can't do it alone.
But he also faces this immense strategic challenge, right? Managing the sheer economics of keeping Moore's Law alive.
That's the tightrope walk. He openly acknowledges that this transition to High-NA comes with very high costs for his customers, the chip makers. His core job is to keep pushing the absolute boundaries of physics, while simultaneously ensuring that the chips produced using his incredibly expensive machines remain economically viable for the entire global tech supply chain. If the chips become too expensive to design and manufacture, the whole engine stalls.
It's a delicate balance. So this unique combination of total technological monopoly in a category with structurally inelastic demand, producing a high-margin product that is utterly essential to the future of AI and computing, it justifies a truly premium valuation, doesn't it?
It absolutely does. Analyst models are increasingly valuing ASML not as a cyclical semiconductor equipment company, but as premium critical infrastructure, like a utility, but with much higher growth and margins.
And the target market caps reflect that.
They do. Projections range from $1.1 trillion up to $1.4 trillion for ASML's market capitalization by 2030, moving into that truly elite tier of global companies.
Okay, so ASML sits at the pinnacle. But this whole monumental build-out, this $7 trillion CapEx wave, and the resulting astronomical valuations, they face enormous structural headwinds, huge risks that could potentially derail this whole trajectory.
Absolutely. Two big ones stand out: geopolitical fragmentation and the ever-present threat of an economic bubble bursting.
Let's start with geopolitics. The U.S.-China tech war seems central here.
It is. It's being fought primarily through export controls, specifically the U.S. and its allies denying China access to the most advanced EUV and even some older, deep ultraviolet DUV lithography systems from ASML and others.
The aim being to limit China's ability to produce competitive, cutting-edge chips for AI and supercomputing.
Correct. And China, predictably, is retaliating where it can, for instance, by imposing curbs on the export of key materials needed for lithography tools and semiconductor manufacturing, like certain rare earth minerals or gallium and germanium.
It's a tech Cold War, essentially. But here's the paradox I found interesting in the sources. This conflict might actually be strengthening ASML's position, at least in the West.
How so?
Because Western government subsidies, think of the U.S. CHIPS Act, the European CHIPS Act, they are pouring billions into funding the construction of dozens of brand new semiconductor fabs in the U.S. and Europe.
Ah, right, diversifying the supply chain away from Asia.
Exactly. And every single one of those new fabs, whether it's being built in Arizona or Ohio or Germany or France, it needs ASML tools to function, especially for advanced logic.
So the push for supply chain resiliency, driven by geopolitical fears.
translates directly into more state-sponsored, diversified, geographically distributed, and highly resilient demand for ASML's monopoly products. It reduces long-term reliance on geopolitically sensitive Taiwan while locking in massive sales for ASML in politically stable regions. It's an ironic outcome.
That's a very sharp point. Okay, so geopolitics might be a complex tailwind, paradoxically. What about the other major risk, the existential one, the specter of this compute bubble?
Yeah, we touched on the gap between CapEx and revenue earlier, but the market concentration itself is becoming alarming, isn't it?
It is. At points recently, AI-related stocks have accounted for roughly 44% of the entire S&P 500's market capitalization.
Almost half the value of the main U.S. stock index tied to this AI theme.
That level of concentration means that if the core assumption driving those valuations, the assumption that AI will generate massive, immediate, scalable profits across the economy, proves to be wrong, or even just significantly delayed.
The market correction could be brutal, systemic even.
Potentially. And skepticism about those immediate profits is definitely fueled by some of the adoption data coming out, like that widely cited study analyzing hundreds of corporate Gen AI pilot programs.
The one with the scary failure rate.
The one that found a staggering 95% failure rate, meaning 95% of those initial corporate pilots produced zero measurable ROI, zero return on investment.
95% failure rate on initial pilots. That fact directly challenges the fundamental assumption that broad enterprise spending will magically materialize to support those trillion-dollar CapEx plans we discussed.
It really does. If this failure to translate initial enthusiasm and pilot projects into genuinely profitable, scaled deployments persists, then the enterprise spending underpinning these current high valuations might simply evaporate, or at least be delayed by years.
Which could trigger the bursting of that compute bubble.
It's the primary mechanism through which that bubble could burst, yes. A crisis of confidence driven by a failure to deliver promised ROI at scale.
Okay, so given these massive opportunities, but also these huge risks, this brings us to the final framework for thinking about valuation across the ecosystem. It sounds like the future will see a pretty severe flight to quality.
That seems highly likely. Value will either concentrate dramatically in the winners, or it will simply vanish for many players.
So the base case scenario looks like what?
The base case is clear. Value accrues highly concentrated within the compute oligarchy. Your NVIDIAs, your ASMLs, your TSMCs, your AWSs, Azures, GCPs, those who control the physical constraints and the core platforms.
And meanwhile, the intelligence tenants, the thousands of AI application startups.
They undergo a painful, potentially brutal period of consolidation, down rounds, and widespread valuation write-downs. Only the strongest, those with genuine moats, survive and thrive. Most don't.
Okay, that's the base case. What's the bear case scenario?
The bear case is, frankly, catastrophic. It could be triggered by a sudden, major geopolitical shock, the nightmare scenario involving Taiwan, for instance. Or it could be a purely financial crash, the bursting of that compute bubble we just discussed if the ROI doesn't show up.
And the result?
A severe industry-wide CapEx contraction. The hyperscalers slam the brakes on data center spending, chip orders get slashed. This would cause immediate, deep, and widespread valuation write-downs across the entire ecosystem.
Including the oligarchy.
Including the oligarchy, yes, though they are arguably better insulated due to their foundational role and pricing power. But everyone would suffer significantly in that scenario.
So if you are building a company or investing in this incredibly turbulent environment, the winners, the survivors, they're going to be defined by possessing three non-negotiable factors, right?
Right.
This is the recipe for a durable moat in the AI era.
Absolutely. First, and maybe most fundamentally, control over physical constraints. Meaning you've somehow secured access to low-cost, reliable energy. Or you've locked in multi-year supply deals for critical components like high-bandwidth memory, HBM. Or at the highest level, you have privileged access, maybe through early orders or partnerships, to the essential lithography tools that only ASML can provide. You control a piece of the physical bottleneck.
Okay, control the physical.
Second, you need defensible non-model moats. This is crucial. Your competitive advantage cannot solely rely on having a clever prompt or slightly better tuning of a public model.
It has to be something else. Like what?
Like genuinely proprietary data. Unique, hard-to-replicate data sets specific to a valuable vertical like legal precedents or medical imaging archives or specialized manufacturing sensor data. It also means achieving deep integration into your customers' critical workflows, making your product indispensable and creating high switching costs, regardless of which underlying foundation model might be powering it next year.
Become embedded. Sticky.
Well,
okay. And the third factor.
Third, and maybe the most challenging right now, sustainable unit economics. You absolutely must have a credible, demonstrable path to achieving high gross margins.
Which means mastering that compute tax.
Exactly. Mastering it through relentless algorithmic optimization, clever software architecture, and effectively leveraging efficient hardware, perhaps including custom silicon if you're at scale. That fundamental ability to monetize your service at a significantly higher rate than you're paying for the underlying compute, that's what will ultimately separate the long-term winners from the fleeting hype.
Right. It sounds simple, but clearly incredibly hard to achieve in practice. Okay, so wrapping this up, we've established pretty clearly, I think, that the future of this $7 trillion AI economy, it's not ultimately going to be determined by who has the best software idea or the most creative prompt.
Not in isolation now.
Oh. It's fundamentally about mastering the physical world. The silicon, the energy grids, the global power capacity, and ultimately that almost miraculous microscopic printing press from ASML that creates the core component. The compute imperative has irrevocably flipped the value equation, hasn't it? Strongly in favor of the oligarchy.
That's the core conclusion from the sources, yes. The physics is dictating the economics.
So let's leave you, our listeners, with this final, maybe provocative thought to chew on. Considering the sheer technical complexity we've discussed and the immense geopolitical significance of ASML's unique monopoly, which of these two potential scenarios presents the more critical long-term risk to the entire AI economy? Is it A, a sudden catastrophic shortage of electricity, maybe due to grid strain or unforeseen events, that forces the oligarchy to literally turn off their shiny new $10 billion data centers?
The power plug gets pulled.
Or is it B, the possibility, however remote, of a genuine technological breakthrough, something completely different, like nanoimprint lithography, finally becoming viable at scale that could actually disrupt the century-long paradigm of light-based optical lithography, effectively ending ASML's seemingly unassailable, indispensable moat. Which failure mode is the bigger threat? That's your deep dive for today.